Hey everyone, welcome to our, is it fourth or fifth slide? I think I forgot, but welcome to the slide which talks about what is it, money generation in the market, in the forex markets, right? So here we are talking about how do you generate money over time in the forex market, right? Using the market, we are talking about the currency market, right? The forex market current, right? So here I have a nice quote which says, if you want to achieve greatness, stop asking for permission. So it's just a quote. These things I usually like to usually put them. It's very important for you to say, if you want to achieve something, keep on pushing, just encouragement. But let's get to our slides. So here we have a picture of this guy who is so happy with the amount that is coming to him. So the question is, how do you make money in trading forex, right? So I think before we start, I think this slide is one of the most important slides that I think one should understand, because here we are now getting little by little in terms of knowledge of how do you trade as a professional, how do you know those little concepts, right? So let me take my highlighter, right? So here we have this guy, right? So remember, when one is buying dollars or euros, right, you are waiting for the price to exceed the purchase price, right? So we are saying, maybe we are saying, when you are buying here, let's say we have a timeline of price which says 2.1, maybe 2.5, right? So we are saying, when someone says I'm buying here, right, at this price, we are saying you are waiting for this price to exceed, right, so that when it goes to another liquid position, you end up selling, right, maybe at this price, right? So this concept, this increase in value, right, of price, is that it helps us to gain, what is it, profit. But if it goes in the other direction, which means someone is losing money, which means it's a loss. So generally the game is equals to profit or loss. It's not always the case you make money in the markets. You can lose money. As I said, that 90% of the of the traders lose money in the market, right? People who are participants, those three people that I talked about, buyers and sellers, and people who are just watching the markets, they usually lose, 90% of them lose money, right? So as currencies are now in floating mode, I think in the history of money, we know that money is no longer backed by gold anymore, right? This floating mode, that's the thing that helps us to say it creates the volatility of purchase price or prices of currencies, right? So the question is, why is this the case? Why is it there is a floating this volatility in the market? Because of supply and demand, right? We are saying there is a battle. One needs to know that there is what we call a battle between buyers, right, and sellers, right? Or just write SE. There's a battle, right, in the market between buyers and sellers. These buyers, they're having a battle here. So it's a bull and bear markets, right? So you're saying this fight, it creates fluctuations in the market, or what we call volatility, right? So that's what we call supply and demand. People who are supplying, who are selling, and people who are demanding, who are buying, right? That's the main thing that you need to know. So there's here what you call a nice table it helps us to understand how do we make money in the markets, right? So let's take example traders action, right? So there is what you call a euro and USD, right? Euro and USD. So traders action, what does this trader do? You purchase, right? So before we talk about this table, there are two things, right? There's this euro and USD. So if someone is involving two things, if you purchase something, if you purchase USD, which means you are using euro, right? Let's not confuse. If you are purchasing euro, which means you are using USD to purchase or buy euros, right? That's what we are saying. So the moment you see someone saying you purchase 10,000 euros, right, which means you're using what? USD, right? So this is what we call a pair. A pair, these are two things, right? We are involving two things. So most of the time, or influencers say purchase a pair. You don't purchase a pair. Of course, we talk about purchase a pair, but it's a wrong way of saying it, right? You purchase one thing using something, right? It's either you're purchasing euros using USD or American dollars, right? So you purchase 10,000 euros, right, at the euro USD at the exchange rate of this 1.81. So what are we saying? If you see such kind of words, if there is what we call euro, right, euro, right, euro USD, right, if its purchase rate is 1.8, sorry, 1.8, right, what we are saying here, we are saying it's 1 is to 1.8. That's what we are saying. So you see these things in banks or whatever, right? So if we say euro USD is cost 1.8, we are saying 1 USD, 1 euros is cost to 1.18, right? 1 euro is equivalent to 1.8 USD, which means this euro has got a value, because you are saying small amount of euros is equivalent to 1.8, right? Do you understand each other? 1.8, I think everyone understood each other here. So we are saying you purchase 10,000 euros at this, right? So we are purchasing. The question is, what are you purchasing with? What are you losing? What are you putting? You are using what you call, because I saying when you are purchasing something, you are using something. We have two things. When you are purchasing euros, these euros, you are using USD. So that's why there is a minus here. Someone is losing, right? In the market, you are losing one minus 11,800 in the markets to buy this. But the question, we agree that if you are buying this, you are thinking that the value of this will increase in the future, right? I think I've explained. So 2 weeks later, you exchange. 2 weeks later, we are saying now the purchase rate, exchange rate is now this, right? So 2 weeks later, now it's 1 is to 2, 1, 2, 5, right? The exchange rate is this. So which means if it's like this, at first it was 1 is to 1.8, right? Which means you are buying, when this 1 euro is weighted to this, right? If it's 1 is to 1.2, which means the value of euro is gained. It has gained in value. It has increased in value, right? Because now you are saying 1 is now able to buy this amount, right? But 2 weeks ago it was buying a little amount, 1.8. Now it's buying this, right? Which means this side, what you call the base currency. Let me talk about this. I will talk in detail. This is what we call base currency and quote current. So for a pair, we have two things that are involved. What we call base current and a quote. A base is this side, this side. A quote current is the one that is quoted to a base current this side. I'll explain. I think it was worth it for me to explain. So we are saying now the exchange rate is now this, which means it has increased in value. So which means now you have your 10,000 euro, right? Which means it has increased in value like this. Let me rub this so that people don't get confused here. So we are simply saying this is increased in value, right? You bought here at 1 point what? At this value, at 1.8, right? But after 2 weeks it's now 1.25, right? So which means it has increased in value, right? Which means more euros are now able, they are now able to buy more USD, right? Which means if you sell, it simply means if you sell these euros, you gain more USD, right? So we are saying, what is the first step from this table, right? We are saying 1.8, right, exchange rate euro USD, right? We are saying 1.8, right, times euro, 10,000 euro. So we are saying 1.8 USD. We need to buy 10,000 euros, right? So we are saying 1.8 times 10,000, right? Then after 2 weeks the exchange rate is now like this, 1.25 times this. So you can see now after 2 weeks, if you convert back your euros here, like I said, if you convert them back here at a higher exchange rate, which is now 2.5, right? Which means you are gaining more USD, which is 12.5. So the difference is plus. This is the difference, which means it's a plus. If it was a negative, which means a loss, a plus is a profit, right? So that's the table. It's very important for someone to understand this table, right? So whenever, I'll summarize, whenever you see an exchange rate, we say is maybe USD, let me summarize so that everyone understood. USD, maybe Swifts, right? Maybe it's equals to 1.8. So we are saying 1 USD, right, is worth 1.8, which means USD, the base currency, has got more power than the quote current, which is Swift's. CH, we'll talk about this, right, notations. So the question is, what happens now? Because these currencies are in what we call floating mode, so it won't be always the case that every day it will be 1.8. This value change every minute, every second. So if it changes, if it goes to maybe now 2, right, which means 1 USD is now able to purchase 2 Swifts, which means USD is gained more power because it's buying more Swifts, right? So you should understand, very important concept, right? So we are saying, if you have, let's say 1 USD, right, in South Africa, right, it's able to buy maybe 15.5 rands, right? And after some time, one is able to buy maybe after some time, now the rand is now with 1:13, which means the rand is gaining. So it's not always to talk about the base current. This we can talk about the gaining value of this side. So at first you had 1:15.5. Now it's 1:13, which means this quote current, it's increasing in value, right? Because it's increasing in value, while least the base current is losing value, is depreciating. So it can be the case of saying this is increasing in value, this is increasing in value. Doesn't make sense. One should increase in value while the other one is decreasing, right? That's the main concept. This means it's now expensive to buy rands, right? Because you're buying now 13 rands with $1, it's now expensive, meaning that rands is gained some value, right? Very important. So this is a current pair. A pair, we talked about, there are two current pairs, right? So I talked about base and quote current. So this is a euro, it's just a nice diagram, and a dollar. You see there is a battle. This battle is what we call supply and demand, where people are buying maybe euros or selling USD, right? There is a battle what people are doing. That's how we call fluctuations in the market, how the purchase price changes over time, right? So we are saying we are quoting one currency against another one. Which one are we quoting? We are quoting a current, the base, right? And I always say the base is this side, the quote is this side. There is a line here. There is always a base. There is no way there is an exchange, base current, quote current. So in exchange rate is simply the ratio of one currency valued against another current. I think I've explained. USD Swift's exchange rate indicates how many US dollars this can purchase this side, or how many Swifts you need to buy this, right? You can use Swifts to buy this, or you can use this USD to buy Swifts, right? Here there's a very important concept, because we always say this is what we call the button that you see first thing when you go to your screen to your broker. You see this button. So always say it's very important for someone to understand what are you pressing on this button, right? Very important stuff. So what's happening? The first thing, as a trader, you're supposed to know which pair are you trading. Is this one, Euro USD. Which is the base current is this, right? Euro. Which is the quote current is this one. I think we have agreed. You know the pair that you are dealing with, right? So the question is, what are you doing here? So we explained about bid price and what so forth, but for now we talked about the bid price and what is it, ask price, right? But the question is, when you are pricing, what are you doing? That's the most important. Let's not focus on the thing that we've explained, right? For now we should stick to say, when you are pricing, what are you pricing? So first thing, for someone or people who confuse this, whenever you are pressing a button, the first thing is that you are affecting here, that is being affected. The first thing is what we call base current, right? The first thing when you are pressing a button, I'll repeat, when you are pressing, the first thing that is affected is a base current. So when you are pressing buy, let's say there's a buy and sell. When you are pressing buy, you are buying a base current. When you are pressing sell, you are selling base current. Do you understand? The first thing, whether which side, when you are pressing which side, there are two sides, this side and this side. The first effect is we are affecting what we call base current. So let's talk about it and see if it works. So we're saying someone is pressing this side, you're pressing buy, right? What are you doing as a trader? If someone comes and press buy here, this side, what are you doing? We are saying you are buying base current, you are buying euros but selling what? USD. Do you understand? You are buying the base current because you are pressing, or I said when you are pressing, the effect is with the base. So we are buying euros and selling USD. So when you are getting in what we call a long position, you are buying, you are not buying a pair. Most people confuse. You're not buying a pair, you are buying the base currency, thinking that it will increase in value, thinking that euro will increase in value from this purchase price to this price, right? So we're not buying a pair. Let's not confuse. When you're pressing this, you are buying euro, selling USD that you have, right? So let's talk about this side. So when you're selling, when you buy sell, what are you doing? You are selling the first effect you said is base. You are selling euro, right? You are selling euro, buying USD. Thinking when you're selling euro, right? I will explain this concept. I think it's very important for me to explain why would you sell your base currency. Because most of the time the effect you are checking the base current, the effect of the base current. So we are selling, your press sell, you are selling the first effect I said base current, then you are buying. So it's always the case, the first case is about base, then you talk about the quote, right? So whenever you are selling, what's happening is when you are selling, this is a sell, right? You are thinking this euro will lose value, then you buy it back here, then you make a profit. So that's what we call shorting. So the question is, I will explain, because here it's very important for me. This is shorting. So if you hear people saying we are shorting, they are buying it back. You're selling something, buying it back. So let's take it for example. So you are a student, right? You have, let's say, a textbook. I'm giving an example to students because most of you guys who requested these videos are students from universities, colleges, and so forth, right? So don't get offended if you are not any students. The information is there for you to consume, right? For everyone, right? So we are saying we have a textbook that you have. No, your friend actually, not you. Your friend has got a textbook. Let's say a textbook that is it's worth $10. $10. Take it easy. I need you to understand a very important concept. Most people, they don't know about this concept. You have a textbook that is $10. Your friend has got a textbook that is $10, right? So you know that in the future this textbook will lose value. After a year it will lose value, right? Maybe it will go to 8 USD, right? So we are saying you are here. You go to your friend and say, no, can I borrow you this textbook, right? You borrow, you don't tell him, you borrow this textbook for $10, right? That is worth $10. You, instead of reading it as a student, you go and sell it for $10, right? In the market. Yeah, maybe this is market. You go and sell it in the market for $10, right? But after 2 weeks the price then falls to 8, right? $8. Then you buy it back. That's what we are saying. You are buying it back for $8. At first you sell it for $10. You sell it for $10 here because it's worth $10. But after 2 weeks or a year, no, not, let's say a year, it's now $8, right? Which means you go and buy it back at $8. Then you go and return this textbook to the owner. right? You buy it back at $8, you return it. So can you see you've made a profit? The difference here, you sell something at $10, then you buy it back at $8, which means you made a profit in shorting process by $2. Most important concept. I think I've explained enough. Let me rub this, but it's fine. Let me rub so that our slide looks neater. So remember that base currency, it is the first currency that is listed. I've explained. The second one is the one that is quoted to. It's a code currency. These currencies are identified by an ISO currency code, 3 letters, 3 lettered. That's why you see most of the case, they say USD. Sorry, very sorry for that. So that's why you find yourself, they call it USD. This is what we call 3 letters. Currencies are quoted to 3 lettered. USD, Canadian, CAD. So they are quoted with 3 letters, right? So very important to know. So this is what we call base currency. This side code current. This is the exchange rate. We are saying £1, right? British pound is able to buy 1.2128 worth of USD, right? So whenever you have an open position forex market, you are exchanging one currency with another one. I think I've explained. An open position is just a trade that is running. You still have an open trade. One needs to pay. You need to pay this if you want to purchase 1 British pound, right? You need to pay this worth of USD to purchase this, which means pound has got a value, more value than USD. So if you buy Euro USD, it's kind of wrong in kind of sense. But most people as traders will just say you are buying this pay, but you don't buy a pay. You buy one thing, selling another one, or you're selling something or buying another one. So we are saying if you buy this simply means that you are buying the base currency and simultaneously. So most of the time, right, in short layman's term, we are saying if you are buying this, what are we saying? You are buying Euro, selling USD. So if you hear someone saying I'm buying a pay, is buying a pay, a base. Always the case, the first effect is the base. So if someone says I'm buying, he's buying Euro. If someone says I'm selling this, he's selling a base currency. I think I've explained about this concept. So in layman's term, buy Euro, sell USD. That's what we've explained. So you would buy the pay if you believe that the base current will appreciate in value or gain in value relative to quote current, right? If the quote current doesn't end up gaining value, which means the base currency is losing value, which means you're losing money, right? I think I've explained about this. So in the markets, we have two types of currencies that we have, right? Types of pairs that we have, what we call major currencies and cross pairs, right? So what are the major currencies? These major currencies are the currencies that we say these are the currencies that are widely traded, liquid currencies. They are liquid currencies. They've more volume, like people are trading. They respect patterns for the past years that people have traded, right? They are quoted against, mostly quoted against USD. It's not always the case. Quoted against USD is not always the case. Like this is pound, so which means USD is quoted against pound. So the first pair of major is pound USD, USD Canadian. So most of the say cable don't need to know these terms. USD Canadian, because they end up confusing you for unnecessary reasons. Australian dollar versus USD Swifts, USD Japanese, Euro USD, and so forth. Cross pairs, these are pairs that are not quoted against USDs, like this, right? So these are cross pairs. So in simply terms, we are saying a cross pair, there's no USD pair, no USD currency involved. Like here, is there USD? No. Here, these are major currencies. Suppose there's a USD here, there's a USD here, there's a USD here, USD. The moment you say USD, it's a major currency. So it's wisely to trade what we call major currencies, because they provide liquidity so that you can get out, right? So let's get to our next slide.